Yo, we're gonna get right into the video. Alright, I'm happy to be rocking with you guys. It's been a long time since I made a video like this, aka Fibonacci retracement video. I'm trying to get back into heavy chart work when it comes to my academy and balance that out with Secure the Swag. A lot of you guys have been asking for a Fibonacci video because the last time I did one was about 9-10 months ago from now. So I'm here, we're ready to rock. Let's get to it. And again, if you guys haven't seen my other Fibonacci retracement video, it is literally right here. You go to my YouTube channel and you click sort by popular, and it is right here. How to trade with Fibonacci retracement 10 months ago, 391K views. Let's get it to a milli. But right now we're gonna get into the remastered version, and I'm gonna give you guys a few reasons, to kind of help you and guide you when you're using it. So first things first, I'm not here to talk about, the golden ratios and the whole meaning behind Fibonacci retracement. It's not that important. All you really need to know is that they add the first two numbers up and they get a third number. And if you divide the last number with the previous number, you get 61.8. And if you divide the last number with two numbers before that, you get 38.2. But you don't got to know any of that. All you got to know is how to apply it on the chart, which is very simple. But let me, break it down for you guys. So for newbies on my channel who never really came across the Fibonacci retracement, I'm going to go over the basics really fast over the next 2.5 minutes. And then the rest of the video is going to be more so, reasonings and my logic behind it and some clear-cut examples on the chart. So basically with the Fibonacci retracement, what traders are looking at is price in a downtrend doing this. It goes straight, oh my fault, there we go. Price comes down, retraces a little bit, and then it continues to go all the way back down in a downtrend. Now in the uptrend is the opposite. It goes up, comes down and retraces a little bit, and then it goes all the way up. Now what the Fibonacci retracement does is it gives us these lines that kind of guides us and helps us realize when price is going to reverse, so we can get a better entry somewhere around here to scale it and sell it all the way back down here to our take profit level. Or on the opposite end, same over here, just these lines that we can go by where we get a better entry and then buy it all the way back up to our take profit levels. So let me give you an example on the chart really quick. Now onto the charts, I'm gonna give my reasonings and my logic, later behind it all. I just wanna give like the absolute beginner for the first 2 minutes of the video, like an example of Fibonacci really quick. So if I can use this bar replay tool, you guys know I like to use this tool a lot just to kind of back test a little bit. Simple, these lines are over here. You go to Fib retracement on the left-hand side, you click it, right? And you draw it from the top to this level right here. The last point price was at before retracing back up in a downtrend. And I'll show obviously an uptrend later on in the video. And then it gets to the 50 level in this example, and then it goes all the way down to the 27 or the 61.8 extension, right? That's just a basic clear-cut example just for, beginners and basics. Now, I do have a set of guidelines that I follow and abide by. I keep it stored in the back of my brain. Like I don't have it like written down on a piece of paper or anything, but I just remember off the top of my brain that I want to show you guys. So if I can just pull it up right now and kind of go down the list. It's the first few right now. So I don't use a Fibonacci retracement on anything lower than an hourly time frame. I only use it on the 4-hour, the 2-hour, and the 1-hour. You guys got to realize that if you do use Fibonacci on the daily time frame, you'll notice that it may take 2 weeks to get to your take profit. And that's real. So if I can just come over here really quick, you guys see that 2-hour, 1-hour, 4-hour, these are the three time frames that I will use the Fibonacci retracement on. And if I do so happen to use it on the daily, then I just got to keep it in the back of my mind and know that it's going to take about 2 or 3.5 weeks to actually fulfill. Now, in those instances where I do know price is going to take 2 or 3 weeks to like fulfill, like let's just say this, for example, if I had it at the bottom here and the top here, right? So A, B, C, all the way to the 50, and then it gets all the way to the 27 extension, right? I know this started on September 14th. This happened on September 28th when it did finally retrace. It hit the 50 on October 1st, and it hit the 27 on October 22nd. So about a full month when you use a daily Fibonacci retracement, which is why if you're a swing trader, Fibonacci won't apply to you as much because you're in and out of the market so fast. If you're an intraday trader, then yes, the 1-hour, 2-hour, 4-hour is perfectly fine. And if you're a swing trader, the daily works as well. But in those scenarios, like when I do look on a daily time frame and I do see Fibonacci, then I will get in and then just buy it till Friday and then get out and then get back in on Sunday or Monday up until that month is fulfilled. But those are rare instances, but that's how you, I guess, get in Fibonacci if you only clearly see it on the daily and it's going to take a few weeks to hit. Other than that, if you're an intraday trader, stick to the 4-hour, the 2-hour, or the 1-hour. Now, back to the slides. 23.6 is irrelevant. If you look at my actual numbers over here on this chart, if I can just scroll all the way over, let me delete this for a second and just go here to here. These are my levels. 0%, 38.2, 50, 61.8, 78.6, and 100. And I do know that the 50% is not an actual Fibonacci number. Like if you were to, take the last number, let's say 1 plus 1 is 2, 1 plus 2 is 3, 2 plus 3 is 5, 3 plus 5 is 8, and you take that 8 and like the 5 divided by the 8, and you get the 61.8, or the 3 divided by the 8, you get the 38.2. 50 is not divided and doesn't factor into anywhere. But 50 is a middle point for 38.2 and 61.8. You see it's about, 11, 12% up, about 11, 12% up as well. So it's the mid-level point. So I do have these three areas as the safe spots when it comes to a Fibonacci. Now, price can get to a 78.6. I would never say 78.6 is irrelevant, but I will talk about more about that level later on in my points. But these are the three main areas that in my experience, that Fibonacci will retrace off of, bounce off of, and then get to the take profit area. 23.6 is irrelevant. It's not a real retracement. If price goes all the way down, then comes up to the 23 and then comes back down. It was just two candlesticks in the opposite direction. A full retracement is like full 4, 5, 6, candles in the opposite direction. You can draw a counter trend for counter trend trading, in the opposite direction before a full drop to the take profit level. But back to the overall point, price can hit anywhere between 38.2, 50, and 61.8. So if I can just give some actual examples on the chart, just like I just did with GBP AUD. So with Euro USD, you look at this pair and you can see it like starting from the bottom all the way up. So some of my points that I'm going to get to in a second, Fibonacci has to be at a low level or a high level. Like it has to be in confluence with something else. It has to start at a key level, start at a moving average crossover or a moving average, retest, break of a trend line, just something. It can't just be in the middle of nowhere. And here, for example, we have this double bottom, but let's just imagine this is a key area. Like I have a blank chart right now. I'm not going to draw support or resistance. You could go to my, YouTube or on my academy and like look at the overall strategy of like this with this with this with this. But just right now, we're just gonna place a minor key level down here, and it'll start here. So Fibonacci, right? If I can click this, starting from the bottom, and you bring it up, right? This is the first one. And mind you, I'm doing it on a daily because it's right now for an example, because it's easier, because it's not that many candlesticks, so I can get through this video a lot faster. But if I were to go down to a 4-hour time frame or a 2-hour, which I usually be, you can see A, B, C, and then D, 27 extension. Now for me to break it down, A to B is however high it gets to before it retraces. So with the Fibonacci retracement, whether you draw it on the bottom for an uptrend, you just draw it and drag it to the highest point. You don't want to, like, let's say for instance, if price is going up, if I can go back to my charts really quick, we'll start it here. If price is going up and you see one little, candlestick right here, this doesn't mean you got to draw the top part right here. You need an actual full-on retracement, which is what you got right here. So this is the highest level, right? And then it gets to the 50% level, and then it goes all the way to a 27 extension. At that point, that's when you can exit out the Fibonacci and then move on to the next one. But now back to my points, what I did realize is the way to figure out if price is ready to reverse off the 38.2, the 50, the 61.8 is it needs about 4 to 5 hits on that level on 38.2, 50, or 61.8 before, reversing, or it has to be a double bottom or a double top. So for example, if I go back to my charts again, you can see clear as day that if I just went back, you can see right here on a 4-hour time frame, this is a double bottom. Boom, bottom, up, came back, retested, and then it pulled right up. And I can show you, like I said, more examples as I get deeper in the video on how it usually hits about 4 or 5 times, or it's a double bottom or a double top before it reverses. Now, most of Fibonacci is all perspective. Like this whole market, is all perspective. That's what makes the market move. That's what makes price bounce off the 38.2 and the 50 and the 61.8 is because I'm not the only one who knows these levels. You look at Investopedia, you look at Baby Pips, you look at my course, you look at freaking books all across America. Everybody's saying 38.2, 50, and 61.8. So it's a collective, unit and agreement between everybody that we know that these are the levels. So the minute it gets there, everybody's buying and everybody's selling. You know what I mean? It's not like the market just on its own. It's like, oh, there's a 38.2. I'm just going to, reverse. Not at all. Usually it's all of us knowing the exact same thing, or most of us, for example, are knowing that it's a level, who trade the Fibonacci and are buying it back up or selling it back down. Now, I did say that a lot of people in the world have, similar levels like 38.2, 50, 61.8. You go on Investopedia, Baby Pips, courses, they all say the same thing. Now, the difference is how somebody teaches it. Like, somebody will teach you to have your stop loss, very, very tight above the last swing high, swing low. Somebody may say above the 78.6. Somebody may say, just always have it 20 pips below. That's the difference with like the courses and the books and everybody else and who you're actually learning from. Now, me and how I go about it is it really depends on the trade, but I do have two clear-cut, differences between the two. Number one, your stop loss should either be above the 78.6 retracement for a conservative stop loss, so you can have, all the breathing room in the world. I'm sorry, you guys can't even see me right now. There you go. So you can have all the breathing room in the world, so that you know that if price retraces off of a 38.6, and then it gets to a 50, and then it gets to the 61.8, and then it gets to the 78.6, and then it still goes lower on a downtrend or still goes higher in the uptrend, then it's like, yeah, it's not for me. Like, I'm cool with getting stopped out. It went all the way to the midpoint of 78.6 and 100. Cool. Now, the other way, which is a more aggressive stop loss, is if it's above the last lower high or higher low, depending on if it's an uptrend or downtrend. So let me give you an example. So back over here for this example, like a more conservative stop loss would be, get this red right here just to have it. This is a 78.6. If you can see it right here, way down here, like way down here. Like, let me just delete this key area really quick, right? That is a conservative stop loss. And this is what I mean where you got to play it by ear, because it depends. Now, if price is like right here on the 50 or 38.2, chances are my stop loss won't be this super low. You really got to take it by trade, because for example, if this just gave me a low, goes up and then retest this low, my stop loss is probably gonna be below this level, maybe even a few pips below to give it some breathing room, but not this super low. So it really depends on the actual trade that you're in. You get your entry, you do a long position, you get in amidst of this moving average crossover and this bullish engulfing, stop loss a few pips below. Take profit can be the 27 extension or the 61.8. And the 61.8 would be a 3.2 to 1 risk to reward ratio. And the 27 extension would be a 2.1 to 1 risk to reward ratio. But that's just giving you guys an example of like the different type of stop losses. Like I said, I'm going off of a list of like what I go off of when I do use the Fibonacci. Now back to the charts, because how I had it was, we had this Fibonacci level, right? And it got to the 27 extension, and then boom, right to the T. So if I can go back to the daily time frame just to kind of show you guys an easier or faster way just to kind of view it, right? It gets to the 27 extension, comes down, retests the moving average, and pulls back up. So you can take this off and now draw a Fibonacci from this moving average, retest to the top, which is where? Right here. This is where price went to, the highest point it went to before retracing all the way back down. 1, 2, 3, 4 daily candlesticks, but on the 4 hour and the 2 hour, you can kind of see it clear as day. It retraces all the way back down. Remember what I said about counter trend trading? You should be able to, more times than not, draw a counter trend, and price should be going off of it. Boom, 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 and then finally break above, retest above, then head it all the way up. So now over here, we get to the 38.2 extension. You can see clear as day. What happens? Hit up to the counter trend line, then hit again. This is a double bottom. Same what I said with over here. If I can go back to the screen, needs 5 hits or a double bottom. And this is, like I said, from experience, it's one or the other. So now you look at this, price heads up and it goes where? 27 extension. Now, for me, when price hits the 27 extension, I usually get out the trade. Sometimes it can get to the 61.8, but I play that by ear as well. Like, I didn't even write this down as one of my points, but just to kind of, keep it in your mind. If I see prices doing like this, these small candles, then yeah, more likely than not, I'm going to take profit. But if I see huge candles being, thrown at the market at the 27 extension, for example, a candle like this, you take that and you put that right here. And then another one like this one right here, I'm going to hold off of it to the 61.8 extension. And people may say, how do you look at the market 24/7 because you have to live your life? That is 1,000,000% true. But at the same time, if I know I'm like actively in a trade, chances are I'm going to be monitoring it, looking at it every hour, every 2 hours, every few hours, just to kind of see, if price is moving, if it's not moving. If I'm in a trade and I go to sleep, I wake up in the morning, first thing I do is open my phone, see if I got stopped out, see if it took profit, see if I'm still actively in the trade. I will monitor it as the day goes on. Now, back over here with more examples. So price gets to 27 extension. So for me personally, I am done with the trade. I am gone. I'm exiting it out. I'm not worried about it no more. So if we can go to the daily, to kind of give you guys an example of like when price is like done and it's retracing, not retracing, it's reversing in the opposite direction. Look at this, for example, right? So price gets way up here, bearish engulfing, right? So let's just draw this key level right across. Now, bearish engulfing, and it follows through. We didn't get that anywhere over here. Like we're still getting a solid uptrend, like an uptrend, retrace, uptrend, retrace, uptrend, moving average retest. Uptrend, retrace to the 38.2, uptrend, retrace, uptrend. Now, reversal, and how do you know that is, this gave a bearish engulfing over here. This did the same thing, but it actually followed through and there was a moving average crossover and then another one. So it's a clear full-on reversal. Now, price comes all the way down, right? And then it starts to go up. So now, I'm just gonna draw this, minor key level right where price stopped at. And price goes down and comes up. This is where all the confluences comes in and the historic art. And this is where you gotta visually, remember on the charts. Like my charts are usually more so empty. Like I have a few drawings on there, but it's more so empty because there's so much going on. You can easily get confused by like having too many key levels, supply and demand, too much support and resistance. Like it's too much of everything. You really just gotta make sure you study the charts enough to the point where you can book it and keep it in your brain. For me, that's a little easier. For those who like to have, I've seen people trade with like, and I want you guys to see my face right now, like 10 support and resistances. There's like 20 lines on their charts. There's like a Fibonacci here, then a trend line here, then a counter trend here, and then like, a red area for exhaustion zones. And their chart looks like a color book. Like you go to kindergarten, you see coloring, that's what their charts look like. And I don't like that. I don't learn that way. It looks crazy to me. So I like to keep my charts really clean. But back to the actual charts, right? So you look at it, back to when I say the art, not only does you draw from A to B, right? And let's take this, bar replay and just hit it right here, right? And the reason I like the bar replay tool is to kind of teach you guys. Like if I'm going off of a live trade, there's no bar replay. It's just live. You got to see what goes on in the exact moment in time, period, in the story. But when you're teaching somebody, you can teach during a live, trade, but most people aren't keen to learning during a live moment. For example, if I am making money or losing money in the market and I'm teaching somebody live, right? And they're seeing me losing money or making money, their brains are wired in a way where they're scared because I'm losing money, or they're too excited that I'm making money. Now they want to make money and they're not really thinking about the process. Like I'm trying to explain, this is why I did this, and this is why it happened, and this is why it happened. They're like, cool, all right, so should I get in right now? And it's hard to really teach that way. With the bar replay tool, I can easily go back in time, kind of calm everybody down, show you guys how it works, and then implement it on an actual trade. So back to the actual art. If you can see it, A, B, C, it goes to the 38.2 extension. Now, if I can go to the 4-hour time frame, look at this, the 4-hour time frame. We have A, B, C, and what do we have? Like 1, 2, 3, 4, 5, 6, 7, 8, about 8 hits to the top before finally coming back down and crashing down. So it's literally one or the other, where you get a bunch of hits at the exact same time, back to back to back to back, or it'll hit it one time, come down a little bit, retest, or hit it one time, come up a little bit, and then retest, and then shoot up, depending on if it's an uptrend or downtrend. Obviously, we know already, if we can just X this out, you can see clear as day, price not only gets to the 27 extension, but then it's done, retraces. And the reason why that happens is because people are taking their money out of the market. Remember, if there's not enough people in the market, it's going to go the opposite way. Why does price go all the way down? Everybody's selling, so it forces price down. Why does price goes up? There's more people buying than selling, so price is going back up. So if everybody is selling, which you can see right here, everybody's selling all the way to the 27 extension. Remember what I said, it's not like the 27 extension is some golden number that price automatically does that. People like me and everywhere across the world are pulling their money out. And when they pull their money out, AKA get out the trade, close the trade, boom, there's not enough sellers anymore, and the buyers have a chance to kind of, regroup, take control of the market a little bit. Guess what happens? Boom, price comes back up. That usually happens all the time when they get to the 27 extension or the 61.8. Which brings me to my point, and now forget this one real quick, because I'll get to that in a second. But look at this one. Price should instantly consolidate and retrace once they hit the 27 extension or the 61.8. Wrong tab. Ugh. I'm trying to work with this mixer, and you guys, I think somebody said in my last YouTube comment, why don't I just put it right next to me so it's easy for me to go through it. There's a loud sound with the mixer, so like when it's under my desk, you don't hear it. You can hear the clear audio, but when it's next to me, you hear a you feel what I'm saying? Like you hear that, I'm like, I can't be working like that, not at all. So I gotta keep it under the desk, so you guys may see my hand go under, but just know I'm not grabbing nothing. I'm just transitioning the slides. But back to that other point that I said that we can skip, let's go back to it. I've also realized that price with Fibonacci will do one of two things. It'll either go directly down to the 27 extension with no heavy retracement, or it'll slide above, below the 0% and then retrace back. Whenever price does that, I usually get out of the trade. It didn't have enough strength to go straight through. What that means is when price, if I can go to my charts really quick, if price literally can come down here, come up, come straight down here, right? 27 extension. Sometimes price will come here to B, go to C, come down here, go up a little bit, come down here, go up a little bit, come down here to the 0. It's doing too much, I'm getting out the trade. Usually more so than not, if price comes off of C and it's coming down with so much force and velocity and momentum, it's gonna get to the 27 extension, I'm leaving my trade on. But if it's slow and it goes to 0 and it comes up a little bit and then it goes down a little bit and then it goes up a little bit, I'm not about to wait for it to get to the 27 extension. Chances are people have already taken their money out at 0. They didn't believe that, you know, the pound or euro or the US dollar or Japanese yen had enough strength to continue on. So they got out. It is what it is. So this is why it's important to know this, because the market, you have to play it by ear. Nothing is guaranteed. Like even me teaching this, like is not, this is why I have to refine it and remaster it, because nothing is guaranteed. It's all perspective. I may tell you guys the 27 extension is where I get out and take profit and where, you know, a lot of other traders take profit at. And then you may get into a trade going off of that mindset and then noticing that price got to the 0% and then people got out. And then 0%, and then you're waiting for it to get to the 27 extension, and then price retraced and then stopped you out. So you really have to play it by ear. And sorry that I'm not looking at you guys, I'm looking at this monitor right here. But the most important advice I can give you guys is to play it by ear. You never know what price is gonna do, which brings me to my last point, or my last 2 points. You can't use Fibonacci for everything. It is not something you can use all the time. So if I can go to my charts really quick, you guys can see clear as day that, go to daily really quick just to kind of make it easier for you guys. So Euro USD is a pair that likes to use the Fibonacci, you know, a lot. You guys may find that some pairs that you're trading, you may not find using Fibonacci as useful for other pairs. For example, I had AUD USD up here as well, because there's no way you can really see where to put Fibonacci. Like it just goes straight up. And if I can go to an actual blink chart really quick, look at this. It just flies straight up. It is what it is. Just keep that in your mind, that you may use Fibonacci more so for one pair and not as much for another pair. But also that last point that I had, like look deep within the charts, Fibonacci is already in the mix of a moving average, crossover, key level bounce, or a strong candlestick pattern. I said that in the beginning of the video, so I kind of went backwards a little bit, but those are my reasons behind the Fibonacci retracement. If I can go to this chart, Euro USD, you can kind of see back to the 4 hour that, like I said, price usually retraces that 27 extension, then comes back up. But look where it also went, back to me talking about, you know, the art level, right? If I can go to the daily so you can see it clearly, look where it bounced off, not just the 38.2, confluence, you need all the confluences in the world. The level it went to beforehand, the first Fibonacci that was used, you know, days prior. So look at this, remember this, we had used a Fibonacci, we got a key level down here, and then we used a Fibonacci from this to this, and then we got to here, right? Cool. And then let me take this off for a second. And then we use a Fibonacci from here to here, this A level right here, if I can just press the replay tool so you guys can remember, right? Here to here, and then it ends up getting to the 27 extension and the 61.8, right? Cool. So if you can draw it across and you are using the Fibonacci for this one, A, B, C, this is a major area, because why? Not only did it bounce off the 38.2, not only did it give us 5 to 6 bounces on a 4 hour and a 2 hour time frame, not only did it cross below the moving average, but it reversed off the same high that it reversed a few days prior. Confluence is everything. Goes up, can't break this level, comes down. Goes up, can't break this level, comes down, retraces the moving average, comes up, finally breaks this level. Where does it come back down to retrace? This level. Then goes up to obviously this main key area, which is a 61.8 off of this trade. Then comes down, can't break this level, retest the moving average. Oh, it finally wants to break. Boom, another level. Comes down to retest. Where does it retest? Doesn't retest a random area, doesn't come way up here. It stops right here because this is a major area. Then comes down, breaks below here, breaks right back above here. So this is why I keep my key areas on. I don't have too much drawings, but like I said, I started this with a blank chart, but if I kept this as my real chart, I would keep this area as a major area. Now, if I can delete this as well, I'm just giving you guys all the examples in the world so you guys can use Fibonacci, in your arsenal. Some people may not like to use Fibonacci. It's all, preference. I personally like to use it. I have 2 screens right now. Bro, I do not know what I'm doing with this thing, but I like it. You guys gonna rock with me, you feel me? But it's all perspective, you know what I mean? Like, some people like to use indicators, some people don't. Some people like to naked trade, some people don't. Some people like to use Fibonacci. Some people think Fibonacci is just a mere representation of a deeper line of support or resistance. I kind of agree with both. Like, you can't use Fibonacci on its own. It's already a factored in support and resistance, but it's just an extra tool and it's easier for me to see 38.2, 50, 27 extensions. Easier numbers for me to remember and to see and to implement on a chart. But again, back to here. If we're looking at this area right here, we see price goes all the way up and we're looking at an actual Fibonacci area. Where do we think price is gonna, retrace to and actually retest before we even draw any type of Fibonacci lines on? Price came down, stopped here, went up. Price came down through a stop to here. Huge wick, came up, finally broke through, came up. Where do you think it's gonna retest next? This exact area. But this is why you need all the confluences in the world. Remember I said, key level, moving average crossover, candlestick pattern. If we had a Fibonacci from A to B and price gets from A to B and comes down to this 50 level, what are our confluences, right? A, B, C. First confluence is that it's actually retesting point B of the Fibonacci we used prior. Same with over here. This was retesting point B from over here. Remember? A, B, C. A, B, C. So point C was retesting point B over here, and same with over here. Point C, A, B, C is retesting point B over here, A, B. I'm not trying to confuse you guys, so hopefully you guys followed up with that. It's very simple, wasn't nothing secret in that message. If you gotta, replay the video, go do that. But that's confluence number 1. Confluence number 2 would be a 50% retracement bounce, Fibonacci. Confluence number 3, and we can kind of picture it beforehand. Look at this. Boom, boom, boom. What is this? You now have an inverted head and shoulders. If you were easily able to draw it here, shoulder, head, and the price, comes down and retraces this 50% level, inverted head and shoulders, pulls all the way back to 122 before it finally consolidates and kind of chills and relaxes. And these are just examples. Like I said, these are just clear examples of just how to use a Fibonacci, how to play around with it, how to, look at it from this perspective versus this perspective, and how to really have all of the guidelines that I have and how to implement it into your own trading. Like I said, Fibonacci is not the most important thing in the world. It's not like it's this crazy strategy. The thing with Fibonacci is it's very confusing to understand, and I'm trying to break it down as easy as I possibly can, because if you understand Fibonacci, it's a very powerful tool that you can add to your arsenal. Guys, this is a very, very long video, and I'm gonna get back to that. Y'all think this setup that we created that you will see on Secure the Swag tomorrow, set your alarms tomorrow at 8 p.m. in the morning or 8 p.m. in the morning. You see how tired I am? Let me go back to my screen. Look what time it is. 1:25 in the morning, I'm making this video. So bear with me, guys. I've been going at it for a long, long time right now. But that's where I want to get back to, my original roots, where I'm just going at the market and just showing you guys everything. And that's what I plan on doing with my YouTube going forward and my academy. As time goes on, I become a better teacher, I become a better trader. And if I'm becoming better, I don't want you guys to have access to old content when I was at that stage of my life. Everything has to improve and increase, which is why I'm a firm believer in, if I create a course in 2020 and it becomes 2024, it's not the same material. It's way more different and advanced material. So you guys stay tuned. Secure the Swag drops tomorrow. It has everything you need to see in it. And I hope this Fibonacci video really helps you guys. Last thing I want to say to you guys, if you guys don't mind, if you guys can go down and subscribe. I didn't even say it in my first 2 minutes. Usually my videos, I'm like, the first 5 minutes, I'm just talking to you guys, telling you guys to subscribe, like the video, I'm chopping it up. Today, I just got right into the video and left it for the end. So with all my hard work, I'm like out of breath. I need some water. If you guys can do me the favor and just like the video, that's all I'm asking for you guys. Like the video and subscribe. I'd really appreciate it. I'll holler at you guys.